Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to a consolidation process where we have a parent-subsidiary relationship. We got two sets of books. We'll be consolidating together as if one. We're going to have a less than fully owned subsidiary. The fair value will be different from the book value, so we'll have to deal with that issue. And there's going to be a goodwill calculation. We'll be calculating this at the end of year one. Therefore, we're saying that the actual purchase took place at the beginning of the year. It's been exactly 1 year later, so we will have income statement account, temporary accounts as well. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We have our information to the left, so we're going to enter that information into the blue area down below, and to the right, we're going to enter our adjusting entries or our consolidation entries, and we'll be taking a look at our data, which will include company P, parent, and company S, the total, then our consolidation entries here, our elimination entries. Back to the information on the left. P purchased a percent of S on January 1st, 2000 X0, so we're basically saying two companies, P, parent, S, subsidiary. Purchase took place beginning of the year, January, and 2000 X0. Consolidation will take place at the end of the year, so a year will have passed. Percent, 75% parent owned or subsidiary owned by parent. The amount paid for that 75%, $99,000. Fair value of non-controlling interest is $33,000. So the non-controlling interest fair value, $33,000. Book value of S, net assets, was $97,000. So the book value of the net assets, $97,000. Book value and fair value differences. So in other words, the book value was different from the fair value for the building and equipment, which was over the book value of $19,400. So if I go back over here, I'm going to say, all right, let's take a look at our financials over here. We've got P's books, we've got S's books. These two are as of a year later after the consolidation. These are as of December. Consolidation took place in January. Now, they gave us the equity section or the book value, but we can kind of figure out what the book value. They might not always do that if they give you the data over here. Like, we might not always provide you with the book value because you can kind of figure out it's only been 1 year out. So you would think that the common stock had not changed and the retained earnings had not changed. So that 97,000 right there, because the equity section or the income statement hasn't rolled in, you would think that would be the book value as of a year ago, because that's the equity section. All right, and then we're saying that the assets and liabilities of S were different, not from this time period a year later, but from the beginning, the time of consolidation, for a couple of accounts, including the machinery and equipment. So we're going to have to deal with that. Let's go back to the right and let's just double check that. That 97,000, the book value of S, again, didn't have to give that if this data was given over here, because these accounts add up to the 97,000. So that, just be aware that if a problem wanted to be a little bit more sneaky, they could not give you that information. So then we got the accumulated depreciation is 27,000 at that point, a year. And then the years for depreciation is going to be 10 years. So we're going to use the 10-year depreciation of that difference. Goodwill carrying amount, 3,100. So in other words, remember when you see a problem like this, we're going to first have to calculate goodwill. Then we're going to have to determine if it has gone down in value. So their carrying amount here would indicate that there has been a decline in value. So we're going to have to first put the goodwill on the books and then consider how much it has declined in value for. Consolidate as of December. So that's going to be a year later. Let's first consider the goodwill type of calculation. That's where I typically like to start. So we want to think about the equity section. This is what we're always going to do, right? We're always going to say, all right, equity section, how is this account calculated right here? And that'll give us a good indication in terms of our elimination entries. When we get into a problem, we can always kind of deconstruct this number, because this number we know needs to go down to 0 at the end of the day. So how did that get there? Well, first we need to consider the purchase that took place. What happened with the purchase? Well, we know that the book value of S was the book value. And again, I can take this number or I can get it, and I'm going to take this as the negative sum of these numbers. So again, this is a year later, but these equity section accounts for S have not changed. So I'm going to pick it up from there. I think that's a safer thing to do. But if they don't give you those numbers, obviously, then they might give it to you this way in the text. And then I'm going to say the fair value over the book value, meaning I'm trying to say the fair value of some of the accounts, including the equipment, that was over the book value. Now you have to be careful here. They gave you the 19.4. Does that mean the fair value was 19.4, or is that the increase in the fair value? And if I look over here, I'm going to say, well, the fair value here, if I say, and remember you have to take the account minus here to the depreciation was 121. So okay, this number must be then the increase or the difference. That's the only thing that would make sense if a problem like these are not worded as well as they could. And it takes someone to really explain them. Obviously, book problems, you got to just get used to the terminology, and then they'll all be the same kind of terminology after you get used to the terminology and see what they're saying. It'll be easy to figure out. But then we're going to say the fair value of the non-controlling interest. So you would think that you would take that and you would then, take whatever percent, 75%. But if we're given the fair value of the non-controlling interest, that's the number I'm going to use. I'm going to say, all right, the fair value of the non-controlling interest is the 97. Therefore, the difference is going to be the fair value of the controlling interest, 19.4 in this case. Something happened there. This 97, I think, is wrong. I'm going to say this equals, they gave us the fair value of is the 33. The 33. Okay, is the non-controlling interest. Therefore, the controlling interest is going to be the subtraction of those two, 116.4 minus the 33, or the 83.4. And then I'm going to compare that to the amount that we paid, because you would think that would be the amount that we would pay if we paid for basically the book value of our interest. But no, we paid $99,000. So again, if you're thinking about what this is happening here, we're going to say, okay, what are we talking about? We're saying basically, if we were to take the book value of S at the point in time of purchase, this is a year later, but if it were the point in time of purchase, assets minus liabilities here would be what you would think that you would pay, but you would think you would pay 70% of that because they purchased 70%. But it's not going to be that if these numbers are wrong. We're going to fair value them. So then we fair value them, and then you would think that the 70% of the fair value is what we would pay for them. But again, it might not be the case because there's something on the books, it was 75%. There's something on the books that is not included at all, and that's going to be assumed to be goodwill. So there must be goodwill then. So the calculation of goodwill that we're going to have to account for is going to be that $15,600. Okay, so let's first consider the equity method. In other words, how did we get to, since it's only been 1 year, we can really dig down on this number and say, how did they get to that number? This number is so important that I'm going to actually make it a different number over to the right here, or a different color, and make it yellow and red, because we want it to get back down to 0 at the end of the day. So let's go ahead and sum these up first. So we got P's books, we have S's books. We're going to then total them up just as we've seen in the prior problems, equals the sum of these two accounts, or these two numbers. I'm going to copy that, Control C, down arrow, holding down Shift, scrolling down to the bottom. And then I'm going to paste this, Control V to paste it. So there we have it. So now we have something in balance. Here's our totals here. And now we want to consider this number because that's going to be one of our key numbers that need to be down to 0 at the end. How do we consider that? Well, let's reverse engineer it. Let's see how we got there in terms of the equity method. Now, we're not going to post these equity method transactions. I just want to think about what must have happened during the year to get to that 355. Now, I'm going to do this fairly quickly because we've seen at least the first half of this before, but it's useful to do this because this will be a longer kind of problem and you want to be able to deconstruct this thing. So I'm going to say, all right, what would have happened first? This investment account is going to be increasing. It's going to be increasing by the purchase price, which was 99. So that's what's happening on P's book when the purchase took place a year ago. The other side then go into cash. So that's standard equity method. Then it would be going up by the income, their portion of the income, P's portion of the income. So I'm going to say the investment account then would be increasing by, I'm going to say negative of, because the income is going to be a credit down here. I'm going to be picking up the income on P, on S's books, income from S. There's the net income, revenue minus expenses, times, we're going to be picking up our portion for P's portion, which is 75% of that 75%. Now, that's too high after consolidation. because we know that there's going to be a problem with this depreciation or this book value being higher at the point of time of purchase of the equipment, which is going to result in depreciation. And we also know that there's an impairment of goodwill, which is going to result in an effect on the income statement as well. So those effects on the income statement that are resulting from these balance sheet accounts differences that resulted from the time of purchase we're going to take them into consideration with our calculation of the equity method. We'll do that in a two-step process, however. So I'm going to take first the normal equity method, just taking the income that S reported, and then the other side is going to be going to the income from S. So we're going to go on down to income from S. Okay, and then the other standard thing that would happen is we're going to account for the dividends. So the dividends, I would say, all right, that means that cash would be going up with relation to the dividends. The other side would once again be going to the investment account, be going down now. And then I'm going to pick up the amount of our dividends. So our dividends are going to be the dividends from S. So dividends going out from S, 16.8 to P times our portion, P's portion, being the 75% of them. So we'll pick up the 75% of those dividends. And there we have that. So this is going to be our normal equity method. Then we're going to consider those types of things that are going to change, and anything that we're going to adjust the income statement account for on S's books, then we should adjust our equity method for here. So what's going to be changing on S's books? Well, we changed the balance sheet account for property, plant, and equipment, and we know that there's going to be a related depreciation to that. So in other words, the PP&E depreciable assets are going to go up by 19.4. So therefore, we're going to have to account the added depreciation, which is going to be an expense. And that's going to be the 19.4 divided by 10. Our portion of that will be 75%. So we're going to account for that income statement effect on our equity method calculation. That's part of our number that's included over here in the investment in S. So we're going to say, all right, well, that means that we're going to have to be then saying the income account, let's say the income account's going to be going down, and the investment then is going to be going down with a credit. So I'm going to say let's calculate this. This is going to be equal to, I'll do this pretty quickly because we're going to see it again when we do the elimination entries. We'll spend a little bit more time on it here, but I just want to reconstruct it now. And this will be helpful if there's a problem. We want to see it calculated both ways. So there's the 19.4 divided by 10. Don't really need brackets, but I put brackets around it. And then times our portion, 75%. So 19.4 divided by 10, depreciation per year. So that's for 1 year, this current year. And then I'm going to times it times 75%, our portion of it. Okay, then we have other thing that's a little bit strange here. We haven't seen this before. We had goodwill, which we'll see how we put it on the books. Similar fashion, we'll put it on the books here. But then we had this impairment of goodwill. The impairment of goodwill results in an income statement account because an asset went down, the other side must be a loss, kind of like an expense. So we're going to have a similar effect to our equity method here, similar to, same accounts affected here. We're going to say that the income in S and investment in S, and what I'm going to calculate this as, and again, we'll do this in the journal entries, but let's just reconstruct it here. 15.6 is the goodwill minus what we're going to say it went down to because it was impaired, 3,100 times our 75%. So I'm going to say this equals the 15.6 down here, and then I'm going to say minus the 3,100 brackets. You got to bracket it for order of operations times the 75%. So that will affect it, and then I think that is it. So now let's consider our total investment and see if this lines up. So I'm going to say here's the 99 plus the 27,750 plus the credit here plus the credit here plus the credit here. That adds up to 103,320. And so we've reconstructed then this 103,320. Let's see the other side. So now when we do our reversing entries to get that down to 0, this little reconstruction can help us do this. We can only do this with the first year of operations. Otherwise, a book problem won't give you enough information. So it's useful to do this when you're looking at the first year of operations. So the income account, it's going to be this, and then we have the income from S and the income here, and so we're going to say that's the 16,920. So that's going to be this account over here. So we've basically reconstructed those. Hopefully that'll help us as we then work these problems. For now, let's hide this though. So I'm going to hide columns D to G. So I'm going to put my cursor on column D, scroll over to column G, let go, right-click the selected area, and hide them so that we can focus in on our data being right next to our information. I'm going to go back to our data over here. Remember that this account needs to go to 0, and we want basically this account to go to 0. So let's make this our yellow-red combo as well. Okay, so we're going to do our elimination entries. Now, this is our most difficult elimination so far. Remember that you can put these elimination entries together multiple different ways. You might just want one long one for the main elimination entry. I think that's easier in some ways, but I'm going to try to break this out into multiple entries so that we can consider them. So let's first think about our first entry. I'm always going to say, okay, we're going to take this investment account. And remember that that needs to go to 0 at the beginning, at the end of the day, but I'm not going to take the whole thing off now because we're going to break this down into multiple components. Then I'm going to take off the equity section for S. So same process here, same process that we've seen in the past. I'm going to take the common stock and the retained earnings. I'm just going to Control C, retained earnings and dividends. I'm going to take those off the books. And so these are credit balances over here. Therefore, we're going to debit them. I'm going to say negative of. I'm going to pick up that 54. And then I'm going to debit this one. I'm going to say negative of the retained earnings. And then the dividends, I'm going to credit it. So I'm going to put it on the credit side because it's a debit. So we're going to credit it to make it go down to 0. So that will remove these 3 items, making them go down to 0. So that is good. We also know that the income, we have to be dealing with this income account. So I'm going to say, all right, then we have this income account down here that I have to remove. Now you would think that I would remove this income account completely, taking it off the books for the 16,920, but I'm not going to do that yet because really I'm saying, look, I'm eliminating kind of the equity accounts, which are these, and then I'm eliminating like the income account, which is net income. This minus this is the 37,000. This portion over here is just basically S's portion of it, and also having been adjusted for those effects on the income statement. So to break this out into components, I'm first going to think about this 37,000 total here, so or our percentage of that 37,000. So I'm going to say, all right, let's say that we're going to say this income, I'm going to debit it, and I'm going to say negative of, and I'm going to pick just our percentage of the total, which is going to be the 37,000 times the 75%. So I'll say 75%. So we're going to pick that up. And again, that number doesn't match, of course, what's in there right now because we made those adjustments for, you know, the goodwill impairment and the depreciations. But that's what we're going to keep it at for now. Then we have to deal with the non-controlling interest accounts. So the non-controlling interest accounts are going to be this one, non-controlling interest. Now this one, and notice what we did. Like we removed the equity, meaning we kind of removed this, and then the equity over on the net income. Now we're going to basically say that we have to break that out to the non-controlling interest portion and the portion that's in the investment account here. So this non-controlling interest in NA, in the net assets of S, how could we calculate that? Well, we could take the net assets of S, which would be the assets minus the liabilities here, or the 117,200, or all of the equity section here would be this amount, and 117,200, same amount. And we can multiply that times the non-controlling interest, which would be, 1 minus the 75%, 25%. So let's do that with a formula. I'm going to say, all right, let's say, what if I said the negative sum of all of this, assets minus liabilities, times, brackets, 1 minus, and I'm just doing this so we can, use our cells here as much as possible. 1 minus 75 or 25%, the non-controlling percentage. And that'll give us the 29.3. All right, so we have that we have to deal with. Then we did the same on the income side of things. We have the non-controlling interest with regards to the income statement. So, right, because we took off, we accounted for our portion of the income here. Now we want to account for the non-controlling interest in the income. So the non-controlling interest in the income is, you would think, just like you would think, right? You'd say, all right, well, we took the income here and we took the controlling interest of it, which was the 75%. So the non-controlling interest must be 25% of that. So that's where we're going to start. We're going to say, all right, so this is going to be the non-controlling interest is going to be the amount of the 37,000 times, I'm going to do it this way, brackets 1 minus, and then I'll pick up the 75,000 over here, 1 minus the or 75%, and that gives us the non-controlling interest. The non-controlling interest is going to appear on the income statement kind of like an expense. And then, so there we have it. So then we'd say, okay, the plug then must be the investment in S. So the investment in S is going to be, you could say it's going to be the negative sum plug, or you can say that this is basically, we're going to put in there the controlling interest of the net assets. So this, we're breaking out the non-controlling interest of the net assets here, and this you can think of as the controlling interest in the net assets. In other words, assets minus liabilities, which is the 117.2, or the equity section, which is all the blue section down here, 117.2 times the 75%. So let's do it that way, just so we can not need we can calculate as much as, break this down as much as we can. So I'm going to say negative, so I'm just going to say negative sum of the assets minus liabilities, and then brackets times the 75%. And there we should have it. This thing should be in balance now. So it's in balance. So there we have it. So we basically, accounted for the equity method, and then breaking out between the non-controlling interest portion and the controlling interest, as well as the income from S, non-controlling interest, or controlling interest and non-controlling interest, as if there were no change that happened. So that's going to be the first component. Then we're going to have to deal with the changes, which are changes like to the income statement and the balance sheet with regards to the change in the equipment, the goodwill, and then the resulting income statement effects for them. So let's post this out first. Let's not get ahead of ourselves here. We're going to say, all right, let's post this thing out then, because I'm happy that thing all worked out. I was a little worried about it. So here we have the 87.9. So I'm going to go down here, say 87.9. It's not going to bring this down to 0, but that's okay. So that's okay. It's still something there because we have to account for those other components, but we're doing good so far. Then on the income, on the equity, we're removing S's portion. So the 54, so notice what that does. Here's P, here's S, here's the total. We removed S, we're back to P. Same kind of thing. This is standard. So this, if you've been working the problems before, this is standard procedure. So we've got the 88 and the 43 adds up to the 131 minus the 43 back to the 88, which is P's portion. Dividends, same process, standard procedure. We're taking off the 16.8. So then we had the P's S total minus S back to P. Okay, so then we're going to go to the income, standard procedure down here on the income, except it's not going to go down to 0 because we didn't take into consideration the changes to the income due to depreciation and the goodwill loss. So I'm just going to take our proportion, which is the 75%, the 27,750, actually results in a debit balance. That's okay. That's going to go to 0 at the end of the day, hopefully. And then we're going to account for our non-controlling interests in both the balance sheet and income statement accounts. So the non-controlling interest balance sheet down here, this is the new thing, of course, and P17 is going to be equal to, this is what we have to do to be in balance, because what we're doing is we're adjusting the entire thing, but then only accounting for our portion with regards to the investment in S and the income, and therefore we have to, the other side is going to be in the non-controlling interest to balance this thing out. The other 25%, the 9.3, and then the income from S down here, the non-controlling interest I'm going to put on the bottom, and so that should be it. So that should be it, and so there we have that. So that puts us back in balance. So much of this is the same. You can construct this in a similar kind of fashion. You're going to remove this, you're going to remove this, you're going to remove this, and then this you're taking your percentage, no matter what's actually in it, and then you got to think about these new components, which should balance out the other side of these things. Okay, so then what we want to do is consider, we can say, okay, now I know that we had a change to some of these accounts due to them, the fair value being higher. So let's do that now. I know the building and the machinery was higher, and I got to deal with that. So it was higher by 19.4 higher. And we also know that the goodwill went on the books, which I calculated down here. It's going to be an asset. It's not on either of the books yet. The goodwill is going to be going up. So that's going to be for originally 15. That's what it went on the books for. That's what we need to be on the books to match out to the purchase price. But then we're going to have to decline it in value to bring it back down to the impairment, because it got impaired somehow to that amount. All right. And then the other side is going to go into the investment. So the investment, but only our portion. So 75%. So we're increasing these for the full amount that they increased as of, not just our 75%, the full amounts being going up here, which means we're going to have to represent our other side 75% to the investment, which we've accounted for, which we saw in the equity method, and then the other side going to the non-controlling interest in assets. So that means I'm going to add these up times 75%. Let's do that with a formula. Negative sum of these two brackets times, multiplying that times the 75%. And then this one, you can say negative sum, plug formula, or these two times the 25%. Let's times the 25% to emphasize that fact. So I'm going to take those two, bracket them up, and then I'm going to say times brackets, and then 1 minus, so we can use our number up top. This 75%, close brackets. There we have that. And now the debits minus the credits should be back to 0. That looks good. Let's post that up. So we're going to say, all right, post it up. Post it up. Like a center in basketball, we're posting here. That's not the same. Okay, we're in P7. I'm going to say this equals the 19.4. So we're increasing that. And then we have the goodwill. So goodwill in P9 equals, we're going to pick up that 15.6. And then we have the investment in S. So investment in S, something's in it. So I'm going to say F2 plus F2. We're picking up that 26.2. It's still not down to 0 yet. Now we went the other way. We went too far, but it's okay. I'm not worried about it yet. And then I'm going to go down here to the non-controlling interest down below in P26. And I'm sorry, not down there. That's non-controlling interest here in the balance sheet side, F2 plus F2, because this isn't affecting the income statement, right? These are balance sheet accounts, the other side going to the balance sheet account, not onto the income statement, although they will have an effect on the income statement because there's a loss related to this, depreciation related to that. Okay, so that looks good. Now let's record those effects on the income statement. Now remember, anytime you record something here in the elimination entries that are going to affect the income statement accounts over here, and I'm not talking like this is part of the elimination, that should go to 0, and this is going to be kind of part of it, but any kind of normal income statement account that's affected is going to then result in something in a problem for the non-controlling interest and whatnot we'll have to deal with. The two income statement accounts that are going to be affected are a result of these balance sheet accounts that we changed. Goodwill now being impaired. If it wasn't impaired, it wouldn't be a problem, but now it was impaired. And the depreciation here. So let's think about the depreciation first. Let's do the normal kind of journal entry, and then think about how we have to adjust the allocation related to it. And then we'll do the two effects on the expense accounts first, and then we'll make the adjustments for them. So okay. So now we're going to say depreciation, normal depreciation journal entry. Let's just think. That's going to be depreciation expense and accumulated depreciation, because we have to add to the depreciation because of that added to the value. Because of the increase in the fair value, we got to add to the depreciation. So this is going to be equal to, we saw this calculation before, it's the added 19.4 that we added here, divided by the 10 years. That's going to be how much it's going to be increasing by total. So I'm going to take that total, and that, because remember, I'm recording now the total amount. I'm not recording P's portion of it. We're going to have to allocate P's portion between the non-controlling interest and non-controlling interest later. But right now, let's just think about the full, just making the income statement correct in general, and then go back in and do that allocation. So I'm going to say, all right, that means the depreciation here would have to be higher by the 19.4, and the accumulated depreciation would have to be higher by that too. So I'm going to say F2 plus F2, and this would go up. Note that this account is posted to the wrong account. I put it in here to the dividends account, and it should be going to the accumulated depreciation. So you can go ahead and put it to the accumulated depreciation, the proper account now if you would like. I'm going to keep it in the improper account because it's there for now if you want to keep the numbers exactly the same, and then we'll adjust it basically at the end. Just obviously realize that that's a missed posting right now. It shouldn't mess anything up. As we go forward, we'll adjust it at the end. Again, if you want to adjust it now, you can do so. And so now I've done something to the depreciation total amount, and I'm going to have to do something then later to this amount down here and this amount here related to it. But before we do that, let's do the same thing for the goodwill. The goodwill up top. Normally, goodwill isn't a problem. We have to put goodwill on the books all the time. But if it's not impaired, we just let it sit there. But here we're saying the goodwill was impaired. We have to test it each year, and they said that goodwill went down. It was impaired, meaning P didn't hold up S's standards and just basically, or whatever. But we gotta write it down. So if we write it down, that means that this asset's going to go down. The other side's going to be a loss. So now that's going to be another income statement account. So the loss is going to be, we're going to say, all right, there's going to be a loss then. And then I'm like getting mad at P for not holding up S's standards, but that's okay. And then we're going to say, there it is. So I picked up the wrong account. Let's try it again. I'm going to pick up the goodwill. Should be decreasing. There it is. All right, now the calculation, we have to bring this goodwill amount, which is on the books at 15.6, down to the carrying value. So that's how it typically will work. They're going to give you what the carrying value is, subtraction problem to get to the carrying value. So I'm going to say, all right, here's the amount of the 15.6 minus the carrying value means we're going to have to decrease it by 12,005 to get from 15.6 to the carrying value 3,001. So there we have it. Let's go ahead and post this out. So we're going to have this loss now on the income statement, which is again going to cause us problems. But let's first record it. Let's say, okay, let's record that. And then let's record the other side of that, which is going to be on the goodwill to get it in place. So in P9, I'm going to say F2 plus F2. We're going to record that 12,500. Bringing it down to that 3,001. So that has been achieved, goal achieved there. Okay, so now that we have these now we have these things that affected the income statement. So that messes up our allocation. We saw this in the equity method too. So in order to get this account down, it's already accounted for here and here, these changes, because you'll recall we did that on the equity side of things. So that's why it's useful to reconstruct that. So now we have to account for the change in that. This is the total change, and we had an effect that needs to be broken out between 75% to the controlling interest and the non-controlling interest at the 25. So I'm going to do that with two journal entries here. I'm going to do our controlling interest first and then the non-controlling interest. So I'm going to say that I know that this income account is basically going to go down because we put something, we've accounted for the income account for the full amount, and it's of the net income. So it's going to decrease. Then the other side is going to be in the investment account for this change, this allocation that took place, right? And then I'm going to take the change, which is basically kind of like two expenses, these two items times 75%, which is the controlling interest percent. So this equals the sum of these two. I'm going to say brackets times, and then I'll scroll up and just pick that 75% up, and there we have that. So that's going to be the 10,830. So the 10,830. Let's go ahead and post that out then. So if I go into the investment the investment account. Let's go up top to the investment. That looks like it's it. That's what ties this thing out. So I'm going to say F2 plus F2. This is going to bring us down to 0. This is exciting. So this is investment in S, and that'll bring that down to 0. Woohoo! And then the other side is going to be on the income from S. So we're going to bring that over here. We are in P18, F2 plus F2. We're going to go to that credit then, and that brings that down to 0. So that's great. So that looks good. We have achieved the goal there. We also, however, still have an issue with the non-controlling interest here and the non-controlling interest allocation up top. So we're going to have to deal with that. Similar kind of journal entry. We're going to say non-controlling interest in NA, and the income is going to be adjusted. So the income is going to be adjusted here to account for this the change in the non-controlling interest, because this non-controlling interest was before we had this change to the income statement accounts that are affected now. So similar kind of process. I'm going to take this is going to be equal. I'm just going to redo the calculation because we could say, this minus, in any case, equals the sum. Let's do this again of these two times 25% or times, let's put brackets 1 minus, and then we're going to be picking up the 75. So 1 minus that 75, which of course is the 25. And so there's the debit and credit there. So then we're going to say non-controlling interest in A. So that's going to be up top in P17. Something's in it. So I'm going to say F2 plus F2. We're going to be picking up that 6,000 or 3,610. The other side down here in the non-controlling interest net income, F2 plus F2. And then we're going to pick up that 3,610 there. So that looks good. All right, so that's the major components here. So we've basically done the major components. Let's do our last journal entry, which is simply going to be breaking out this accumulated depreciation. So notice this is our longest problem here. Let's just think about this one more time. This one up top removed the equity section just like we always did, but then we had to tack on the fact that we had the non-controlling interest here and here. And then we thought about the increase in the difference, fair value, book value, the goodwill on the books, then the building, breaking those balance sheet accounts out to the investment, breaking them out between investment and the non-controlling interest. Then we thought about the effects on the income statement as a result of these changes to the balance sheet, which are depreciation and the impairment in this case of goodwill, which is kind of unusual. But, that's another expense account. This is the total, thinking about the total effect on the income statement. Once we figure the total out, then I would go back in and think about the allocation of that total between the investment accounts and the non-controlling interest accounts, the effect that it has on the breakout that we had done originally without taking into consideration any changes to the income statement accounts. Now we're finally going to do the last journal entry, which is basically the same thing we've seen before, and we're going to net out the accumulated depreciation at the beginning to the building and equipment. So let's do that same kind of journal entry. I won't spend a lot of time on it because we're kind of running long here. So I'm going to say this equals the accumulated depreciation, and this is going to be the building, and so that is here, and we should be able to, because it's 1 year out, again, they might do this kind of tricky thing where they would say, all right, well, this is the amount that's in the accumulated depreciation minus, or let's say plus, because it's going to be a debit minus a credit, the amount that's on the depreciation expense for the current year, and that should be the difference. Now, you can only do that if it's 1 year out, and that's one way to back it out. If they don't do that, they'll give it to you in the problem. So I flipped the sign, then I'm going to say negative of that number, and then let's just post that one out. So the same process we've seen in the past. So I'm going to say the accumulated depreciation plus, pick up that 27, and then the building and machinery, F2 plus F2, and we will pick up this 27 credit. And so that should bring us back down. So at the end of the day, these should go down to 0. And if you're having problems like matching that up, then what you want to do is I'm going to unhide the equity section over here. So we'll unhide these cells over here. I'm just going to go from B to H. I'm going to put my cursor on column B, go on over to H, right click on the selected cells, and unhide. So, and you may think about this different ways. You might, in your mind, like I say, I think it's useful to do this whole thing in one large journal entry. You know, pretty much this whole thing on one large journal entry sometimes can actually be an easy way to do it, because you can remove this account entirely. But obviously it's really useful as well to see this in these kind of components. But you could break these into different journal entries. As you do so, though, it's really useful if you work on a problem that has the first year only, so or a problem that you've reconstructed the equity method, because you could start, if you have a problem with tying these out, you could see how these journal entries should be deconstructing this account and this account in some way, and it should match the deconstruction that happened here within the equity method. So however you group this thing, however it makes sense in your mind, you need to be reversing, in essence, what's happening in the equity method. And when you're considering the problem, make sure that you've determined whether or not the equity method, or in other words, this account and this account, is taking into consideration the changes within that calculation to the income statement that would result from combination, including in this case the depreciation and the decrease in the goodwill. If it's not, in other words, if the equity method just took into account these accounts, right, and didn't record this, then they should, most problems will record these. But if that were the case, then you could adjust, you know, your combination entries will be slightly different. You won't, they might even be easier, you know, if that was the case. But bottom line is you're deconstructing, you know, this equity method, and that'll help you to think this through. Before we close this thing out, note there was one missed posting. I just want to correct it now. We've mentioned it in the prior presentation, so we went back and let you know about it. So this is going to be that adjustment. This one is going to, this accumulated depreciation is going to dividends when it should be going to the depreciation, accumulated depreciation up top. So I'm going to double click on the accumulated depreciation. I'm going to post it to the proper account, and then I'm going to remove it. I'm going to double click on this account and remove it here. And so then this should be back to the 36, looks good. And then the accumulated depreciation now at the 142 at 940.